So, you want to own a rental property? My name is Garrett Wong, owner of Upper Edge Property Management. In today's segment, I'm going to be explaining how to run the numbers, more specifically, how to calculate cash flow and predict if the property should be a target as your next rental property. Okay, let's recap. You've assembled your real estate dream team, you've spoken to your realtor and property manager, and have chosen a great rental neighborhood and have an idea of the possible rental rates in a property in which you're very interested. So what's next? Book a showing with your realtor? Wrong. You can see I'm in front of my computer, and you should be as well. You need to run the numbers, or more specifically, calculate your projected net cash flow on the property so you can determine if it's worth purchasing. And if the numbers don't make sense, don't bother looking at it. Without the benefit of knowing your numbers, all of a sudden you're talking about writing an offer, or worse yet, you start jotting down cash flow numbers on the hood of your car on a fast food napkin. Yeah, we've all been there. I firmly believe the numbers have to make sense before you even see the property. Calculating cash flow is really no different than calculating a profit and loss statement for a business, but much simpler. You have your income, your rents, laundry, parking, any other types of revenue, and you subtract your expenses, typically mortgage, property taxes, insurance, property management fees if you're using a property manager. You should also have line items for vacancy loss and maintenance costs. A good rule of thumb for those is to use 5% of the gross rent. Let's say you have a 3-bedroom home and your property manager has estimated the rental rate to be $1,500 per month. You also have $50 for parking revenue for a total of $1,550 per month. The property's for sale for $250,000 and the bank is asking you to pay 20% as a down payment, which means you will have a mortgage amount of $200,000. You go to any bank and credit union website to use your mortgage calculator, and in this example, I like to use CMHC's calculator. Simply enter the purchase price, your down payment and interest rate, and it gives you an estimated mortgage payment of $846. You look at the tax rolls and get an estimate of insurance from your broker. So let's do the math. $1,550 in income minus $846 for mortgage, $110 for insurance, $180 for property tax, again these are examples, $155 for property management, and I'm taking 10% of income as an average, minus $78 for vacancy, which is 5% of $1,550, and another $78 for maintenance, also 5% of $1,550, which equals a net income of $103. And that's all there is to it. Join us next week where we'll be diving into construction costs and how to estimate them during a property walkthrough. Thanks for watching.